and take your seats. We're going to start in a couple of moments. Please come and take your seats. Thank you. Morning, everyone. Do please come and take your seats. We'll start in 1 minute. Thank you. Thank you very much for joining us, bright and early. Great to have you with us. And welcome to the 2023 launch of the Absa OMFIF Africa Financial Markets Index, which we're really pleased, I have to say, this year to be launching in Africa. It's a very important piece of work for us, but I think more importantly for the economies it focuses on, as you'll hear in our discussions and panels today. And since its launch in 2017, AFME, as we call it for short, has endeavored to demystify the pretty heterogeneous group of countries in Africa as destinations for investment, and indeed, therefore, help facilitate that as a means to economic development in those countries. As a result, it's a set of data that the IMF and World Bank follow with interest as well. So it's appropriate and fitting that we launch this each year during the IMF autumn meetings. So once again, welcome to Marrakesh. We make the index by applying global market standards on key issues such as market accessibility, openness and transparency. My colleague Nikhil will take you through the fascinating results in a little while and show you the pillars that we measure and how. The aim is to measure progress in the development of capital markets and demonstrate to individual countries that actions they could take to attract international investment to their markets will generate results for them. The strengthening of local markets has an obvious benefit, of course, the world economy as a whole, and we're seeing that, we think, at the moment, the huge increase in the price of money over the last year or so, which has generated stress, but perhaps not the problems that it might have done a decade or two ago. So we hope that this index in its own small way helps reduce pro-cyclical shocks in the global economy to help prevent capital taking flight in turbulent times as well. At OMFIF, we're proud of the continual evolution of the index over the last 7 years and the importance of central banks, ministries of finance and stock exchanges across the region attached to their scores. And I can promise you that they do. We are the subject of sometimes quite intense lobbying from some of the countries that it's feature in the index. We started measuring 17, it's now up to 28, and I think that speaks for itself. So the index is organically attracting an increasing number of countries as it becomes more and more well-known and significant. And we intend to launch some of these data in specific countries featured in the index over the next year. Among the countries we cover, 3 that ranked in the top 5 in our inaugural rankings retain their positions in the highest tier. South Africa, of course, Mauritius, and also Namibia. Nigeria ranked 6th of 17 in 2017, and also Uganda, rising from 10th of 17. They round out the top 5. Progress over the past years has been encouraging. In previous generations, as I mentioned, the global shocks of COVID-19, war in Ukraine, and its second-order effects, issues around food and energy security, and rising inflation might have derailed or delayed important advances in capital markets. Today, these countries, we hope, and know, I dare say, are more resilient. There are other important developments in Africa that OMFIF is following very closely. I know Absa is as well. We talk a lot with African central banks about payments, the move to digital payments, CBDCs. And I'd say Africa is actually at the forefront of that discussion in many ways, because there's a real tangible benefit to cashless payments in Africa as a means to increasing financial inclusion and improving the economy as a result of that. So we follow that with great interest. Do join our sessions with DMI on the emergence of CBDCs and digital payments innovations in Africa, and I know that Absa is going to concentrate on that more and more as well. I would like to really thank all the institutions that devoted valuable time to compiling this index and to assisting our research through in-person conversations or indeed filling out surveys. Thank you very much for doing that. Thanks also to the UN Economic Commission for Africa and the Southern African Development Community for their invaluable support. And particular thanks, of course, to our partners in this project from day one, Absa and the team under Arnold Rauterbach, the group CEO, for their commitment, not just to this project, but also for their important work on developing Africa's capital markets. Special thanks also to Jeff Gable, Absa's head of research, and George Asante, managing director and head of markets. We've stopped regarding them as clients, I dare say, and would almost regard them as fellow employees at times. So thank you very much for that. Before we get into the survey findings for this year, I'd first like to introduce Antonio Pedro, Acting Executive Secretary of the United Economic Commission for Africa, who also made important contributions to the compilation of our index. So over to you, Antonio. Have a great breakfast. I hope you find the findings interesting, and we look forward to getting into the discussions and the data in a moment. Thank you.
Excellencies, distinguished delegates, ladies and gentlemen, it is my honor to welcome all of you to the launch of the Absa Africa Financial Markets Index 2023, organized together with the Official Monetary and Financial Institution Forum, OMFIF. This meeting is taking place at a significant moment in time. 2023 marks the halfway point to the deadline set for accomplishing the SDGs. Among other factors, the COVID-19 pandemic, surging inflation, and geopolitical turbulence have substantially worsened the prospects of realizing the Sustainable Development Goals and the African Union's Agenda 2063. One of the core challenges towards achieving this critical agenda is the financing gap. For instance, the cost of transport and service infrastructure required to enable the implementation of the African Continental Free Trade Area is about $500 billion. Moreover, due to more frequent extreme weather events and changes in weather patterns attributable to climate change, Africa alone is estimated to require up to $86 billion annually to implement adequate adaptation measures by 2030. These are just two examples from a long list of investment needs. To close the financing gap, African countries will need to make better use of their domestic capital and gain greater access to global capital. For example, African pension funds should be incentivized to invest locally. Special purpose vehicles, or SPVs, should be created accordingly. These SPVs would equally enable the harnessing of remittances from the diaspora to channel into more productive investments. All of this requires deeper, healthier, more efficient, and more inclusive financial markets. Strengthening financial markets and diversifying the investor base will not only enable governments to mobilize more funding for economic recovery and sustained development, but also enhance financial resilience to future shocks. To foster the development of their financial markets, countries require a comprehensive approach, encompassing capacity building, robust infrastructure, essential reference tools, benchmarks, and opportunities for peer learning. The Absa Africa Financial Markets Index has proven highly valuable in offering insights to countries, which aid policy making and guide the prioritization of financial market development initiatives. Notably, this year's edition of the index covers 28 countries, marking a significant milestone as it includes more than half of the continent's countries for the first time. At the United Nations Economic Commission for Africa, we are delighted to have supported Cabo Verde and Tunisia in their inaugural participation in the index. The index assesses market across 6 pillars, namely market depth, access to foreign exchange, market transparency, tax and regulatory environment, capacity of local investors, macroeconomic environment and transparency, and legal standards and enforceability. As we witness the rapid emergence of new opportunities and challenges, the index has evolved to reflect emerging trends, including those related to financial technology and environmental, social, and governance policies. ECA takes great pride in this successful collaboration with the OMFIF and Absa. We have found the index to be an important tool for informing policy decisions and facilitating peer learning as part of our commitment to assisting member states in the development of their financial markets. Today's workshop will introduce the 2023 edition of the index, highlight the latest market updates, and address technical questions regarding data sources, methodologies, and indicator compilation. We look forward to meaningful discussions with stakeholders and anticipate that this event will offer an opportunity for you to contribute your insights and feedback. I extend a warm welcome to all of you and wish you productive deliberations on strategies to strengthen financial markets in Africa. Thank you.
Thank you very much to the United Nations Economic Commission for Africa for supporting this work along with Absa, and a special thanks also to the OMFIF team. I'm very pleased to introduce Jeff Gable, Head of Macro and Fixed Income Research at Absa Group, and also Nikhil Sanghani, Managing Director for Research at OMFIF, to present the findings and go into a little bit more depth on those 6 pillars we've just heard. Nikhil will then introduce the panel and we will have a further discussion. So thank you.
Good morning, everyone. And to those joining us virtually as well, as introduced, my name is Jeff Gable. I'm fortunate enough not only be part of a Pan-African bank and part of this 7-year project, but also be deeply passionate about sort of the openness, the transparency, and the accessibility of our markets on the continent. As we've heard already, from the opening comments, it's really important in some ways to highlight what the index isn't about. So it isn't about where the highest returns necessarily are right now on the continent. It isn't about where the greatest needs for capital are. Both are very important topics, but it's not what the Absa African Financial Markets Index is about. Also, sort of reflecting on some of the feedback we've had over the last sort of 7 years in this journey, often people ask the question, so why is this country here, or surely that country can't be? So it's also important to highlight this isn't about kind of global competitiveness or the ease of doing business or governance or any of these. It's very specifically, right, about sort of encouraging this open, transparent, accessible financial markets ecosystem. Why is that important? Well, we often focus when speaking about Africa on Africa's need for capital, right? And so we think the contribution of the Africa Financial Markets Index is about generating discussion in that space that helps sort of foreign capital, local capital come together, right? Savers and users in that space. This was really important when we started discussion way back in 2017. And we think about the developments that have taken place since then, global pandemic and the clear economic scarring we have as a consequence of that. Real questions around sort of debt and date sustainability in many parts of the emerging and developing world, and certainly in parts of Africa. We've heard already that the global cost of money is just much higher. Geopolitics, so the contestation, the difficulty of attracting capital, of putting it to use, has never, or certainly for several decades, not been higher. And so this discussion becomes very important in that space. What do we expect from it? Well, we expect from the index discussions like we start here today, discussions that will take in country over the coming months. It's putting together policymakers and regulators. It's putting together market participants, both those that provide capital and those that need capital, to have the sort of discussions, the learnings. One of the, I think the most interesting sessions I've attended over the last couple of days here at the World Bank IMF annual meetings was a session around capacity building in Africa and the real importance that is. The centrality of the IMF and World Bank's job is ensuring countries are able to learn and gain skills and to be able to provide better for their people going forward. Well, this is a part of that, right? This is a discussion between Africans about how we can make our markets more transparent and accessible. So there's plenty to focus on. One of the interesting components, despite the very difficult environment that we're in, one of the interesting components that I find each and every year is when we go country by country, you'd struggle to find a country that in the previous 12 months hasn't actively done something to help encourage open, transparent, or accessible markets. So no country here is standing still. If we think about the topic of something like ESG, we know right now of the 28 countries in the index, 20 of them have active sort of regulation or enabling rules to provide for an ESG environment. 11 countries have produced or introduced product in that space. Some of the developments that we've seen country specific over the last year, well, we've had a carbon market introduced in Mauritius, Cabo Verde with their inaugural blue bond. You've had new ESG guidelines in places like Eswatini. A South African corporate has issued the continent's first gender-linked bond, for example. So there's much happening in that space. In part, this focus on ESG, of course, is around ensuring sustainable finance. But in another part, and maybe frankly a little bit of a cynical way, if there are pools of global capital that wish to invest in sustainable product, well, as Africa, we must make sure we position ourselves for that product. And in a kind of similar vein, one of the exciting introductions we have for the index this year, we've included the existence of Islamic finance products and rewarded countries score for that. So for example, we have South Africa and Tanzania introducing sukuk bonds in the last 12 months or so. The index also talks about the deepening of markets, whether it be sort of lengthening of yield curves. We saw Lesotho issue 15-year bonds for the first time in the last 12 months or so, or whether it be at a sort of short end of things, introduction of a repo market in Angola. And of course, and as focused on in the second pillar of our index, just foreign exchange, access to foreign exchange, transparency around foreign exchange is absolutely critical. And so one of the exciting developments we've seen just over the last 3 or 4 months or so is sort of the work Nigeria is doing, sort of unify its exchange rate regime in that space. We've heard already that we're very excited to include Tunisia and Cabo Verde this year. That takes us to about 80% both of the continent's GDP and its population. And that's up from about 65% when we started. Taking a step back, what's broadly interesting is that the vast majority of countries that have been included in the index over the last few years has been around reverse inquiry, by which I mean countries have come forward after a launch like this and say, you know what, we think what you're doing is very interesting. We'd like to participate. We'd like to be measured in the same way. We'd like to be part of that discussion. How do we generate the scoring, right? Some of it's a little bit subjective, but Nikhil and the team have been working very hard to ensure more and more objectivity as we go forward. A lot of it's hard data. So there's more than 40 indicators. You see this on the inside back cover of the hard copy in front of you or the soft copy, those that are joining us virtually. We get feedback from more than 50 participants, helping to provide the data to ensure sort of the accuracy of what we've got. There have been some changes each and every year. We try to improve the quality and applicability of the index. So as I mentioned already, we've included the existence of Islamic products this year for the first time. We've changed a little bit the way that we measure capital controls for countries. We've changed a little bit the way in which we account for global master agreements. So it's an evolving product, and the specifics of those changes, the drivers of those changes, how they would have impact scoring is also included in the inside back cover. We organize ourselves. I mean, the concept of open and transparent and accessible markets, that's a pretty nebulous concept, right? And so when we started on day one, we made a pretty big laundry list of those things we thought were relevant for this topic. And then we whittled that down a little bit by those things we thought might be achievable for this topic, but we still ended up with more than 40 indicators. And so we try to organize ourselves around 6 broad themes, or what we call in the document pillars. The first of which is market depth. So there we're thinking about what financial products exist. We think about how liquid they are. Access to foreign exchange is absolutely critical. It's not just about things like FX liquidity and foreign reserves. It's also about information. It's being able to know what the exchange rate is on a particular day. And we also think about sort of the flexibility of the exchange rate regime in that space. The third pillar is around tax and the regulatory environment. It's around market transparency. There's things in there, for example, like the existence of credit ratings, not just at the sovereign level, but also at the corporate level. Again, helping to shine light on the corners of finance to make it easier for investments to find their place. The fourth pillar, particularly passionate about working as an African bank, is around the capacity of local investors. And there we're looking at local pension funds, not just pension funds and assets they may have overseas, but really their investments onshore, focusing very much on this as a source for long-term local currency capital on a continent where often we focus on the lack of long-term local currency financing. Fifth pillar is around the macro environment. Things there include stuff like how quickly a country is expected to grow, how well they manage inflation and others, but it's also about transparency, right? So how clear is the fiscal process? How transparent is monetary policy set? On the idea being that the more transparent and clearer these things are, the more investable are these markets. And then the last of the pillars is really around sort of, I guess, intellectual financial property rights in that space. It's around collateral positioning. It's around the use of standard global master agreements and others. Again, you'll find the full list and description of each of these indicators kind of on the inside back cover spread of the document. Now, of course, people are going to be focused on the rankings. We've heard already in the opening comments that our top three for this 7th edition, the top three are the same as was the case last time. So it's South Africa leading the way, followed by Mauritius, followed by Nigeria in that space. When you look at the graphic in front of you, anything that's in green means a country that's improved their score from a year before. So you'll notice two things in that space. One, there's kind of more green the further down you go than there is high up. Indeed, South Africa and Nigeria both saw their scores fall a little bit in the most recent years. So we're seeing some compression of scores, right? Those with more to do have been on average kind of doing more through time. Our top five also includes Uganda and Namibia. And I want to do a particular shout out for Uganda. Over the 7 years we've been doing this project, Uganda is increased its score by 16 points. So it's increased its score by about a third over that period, only equaled by our host country, Morocco, and only bettered in just by 1 point by Seychelles. So real indication of big progress being made across the continent. Of course, this is less about who came first, second, and third, and more about ensuring there's as much green as possible, right? We want all countries to be lifting, all countries to be learning from one another. That hasn't been very easy, certainly wasn't easy through the pandemic, still not very easy, right? We measure in the index things like the size of capital markets, and given what's going on in global markets, there's a lot of depression in sort of equity markets and others on the continent. But if we split it in a little bit of analytic way and think about active things countries are doing, introducing legislation to enable sustainable finance, introducing global standard agreements and other things. If we split it between those active decisions countries are making in passive, my market cap went down because global turmoil. What we see is that green on this page would look much more prominent. Countries are actively making progress each and every year, even if in some sense, the global environment is handing them a very difficult set of cards. And for our new entrants, right, each and every year, it's about moving up the table, it's about learning from others and starting this very exciting journey. Those are the opening comments that I wanted to make. We've got 6 pillars to work through, but away from me, we thought the best thing to do is hand it to the people who do the actual work on the report. So Nicole will come up and talk you through those 6, but thank you very much for this part of your morning.
Thank you, Jeff, and good morning, everyone. Just to exemplify some of the progress that has been made, which we can see on this next slide, which Jeff mentioned, there's been a number of increases in scores compared to when countries were first introduced to the index. So the darker circles here show the scores from this year, and the lighter ones show the scores from when countries were first introduced to the index. Many of them were when we first started this project in 2017. The green circles here are the ones that have progressed since they were first introduced to the index. That's 17 of the countries. So it just exemplifies what Jeff said. There has been, despite all the difficult global conditions, progress across the continent on developing financial markets, which is great to see. In terms of the 6 pillars, I'll quickly run through some of the main findings. So the orange bars here for showing for pillar 1 the score for this year, and the dark circles are showing the score from last year. Generally speaking, markets have come under pressure in the past year, which is, I suspect, not a surprise to anyone here. The global conditions have been very difficult, and that's weighed on the size and depth and liquidity of financial markets, which we consider in this pillar. And so scores fell in 16 of the countries this year. That's also particularly the case because we look at it in dollar terms, and exchange rate depreciation has weighed on the size of countries' markets in that sense as well. There are some notable exceptions to that. Malawi, Cameroon, and Mozambique increased their scores. And it's worth mentioning that South Africa once again leads on this pillar. It has the most liquid, the deepest and most advanced financial markets on the continent. There has been underlying progress, though, even if it's not completely reflected in the scores. We have seen improvement in product diversity and developments in market infrastructure in the past year. Some of these Jeff has already mentioned. For example, Islamic financial products becoming an increased focus, and is something that we've now introduced in the index and the scoring for it. So as Jeff mentioned, we've seen the first Sukuk bonds in South Africa and Tanzania in the past year. That makes it to 8 of the 28 countries now have it in their domestic exchanges. We also saw from some of the survey respondents that in Mauritius, Kenya, and Ethiopia, they're looking into this and expect issuances in the near future. ESG, as we've already heard, is an increased focus as well, and there's been some interesting new innovations. So as we've already heard, the gender-linked bond in South Africa, in which the interest rates are linked to the company's performance on achieving greater gender diversity on their board. And there's also, for example, a sustainability-linked bond that's expected in Rwanda as part of their World Bank project. So it's not just one type of ESG product like a green bond. There are various different types that are coming to market now. More generally, there's been quite a lot of improvement in the underlying infrastructure to improve the efficiency of financial markets. So we've seen upgrades to central securities depositories in 9 AFME countries to improve the efficiency of transactions and the safety and security of them. Another great trend that we're seeing is in Ethiopia, they're moving ever closer to launching a securities exchange, which would bump it up the rankings. They launched a capital markets authority at the back end of last year, for example, and there's ongoing work to set up the securities exchange there. Moving on to Pillar 2, so this is a similar chart to what we've just seen, in which the orange bars are showing the scores for this year and the brown dots from last year. Again, this is one where the difficult global conditions have weighed on scores. So one of the key metrics we look at here is the size of foreign exchange reserves in terms of months of imports. And that's a measure which has declined almost across the board this year. And so for 17 countries, they saw a fall in their score for this pillar, only rising in 9. Again, as mentioned, that's been linked to some of the capital outflows that has been from emerging markets, which has been broad-based. And in many cases, for the commodity importers, they've seen a deterioration in their trade balances, which has led to reduced foreign exchange reserves as well. That's particularly the case in some of these countries like Egypt and Ghana, who've seen their scores decline on this measure more than most. Interbank foreign exchange liquidity has declined too for many countries, although Morocco is one exception to that trend. Their score rises by 3 points because of the improvement in FX liquidity, and they're now 3rd in this pillar. Moving on to Pillar 3, this is one where we did see pretty broad-based improvements. This looks at market transparency, tax, and regulatory environments. Here, scores rose for 18 of the countries, only falling in 7. There's 2 key metrics here which has driven the increase in scores. So one of them has been an increase in the number of credit ratings across the continent, both in terms of sovereign credit ratings and corporates. That's by international ratings agencies like S&P, Moody's, and Fitch, but also for GCR, the Johannesburg-based credit rating agency. The other key area where there's been an improvement in many country scores is on ESG, as we've already mentioned. In this pillar, we look at the underlying market framework to support sustainable financial markets. So that's on areas like climate stress testing, like incentives to issue ESG assets and improvements in market standards. And on those fronts, Morocco, Botswana, and Rwanda are some of those that have increased on this measure. Just to give a bit more detail, so in Zimbabwe and Morocco, they've introduced climate stress testing or regulations for banks to report on climate-related financial risks, which has seen an increase in their scores in this pillar. There have been new tax incentives for ESG issuance in Botswana, and otherwise there's been new market standards introduced in the likes of Ghana, Cabo Verde, and Eswatini. As mentioned, we've seen a broad-based rise in the number of sovereign and corporate credit ratings across the continent, although there's still a long way to go in improving the market environment. And in many cases, we've seen from some of the survey respondents for our research that tax environments are becoming more challenging to investors in some cases. So there are some concerns raised by respondents about the rise in capital gains taxes in Egypt and Zimbabwe, for example. And other survey respondents mentioned issues around complex tax systems or a lack of harmonization. So even if the rates themselves might not be as high, the way they're implemented can be difficult for investors to manage. Moving on to pillar 4, this again is a pillar where we've seen some difficulties. So scores fell for 19 countries, only rising in 5. Again, this is linked to some of the difficult global conditions where one of the key metrics we look at here is the size of local pension markets in dollar terms. Again, exchange rate depreciation and the sell-off in financial markets across the continent has weighed on the size of pension markets and pretty much across the board. There are some exceptions. Namibia continues to be the leader on this measure, scoring 100. It has the highest pension assets in per capita terms in the region. More generally, some of the countries in Southern Africa tend to score fairly well. They have the most developed pension systems in Africa. Now, although it doesn't explicitly feed into the scores, there are various financial inclusion initiatives that we look at which help to build the capacity of local investors. I'd like to run through a few of them here. So there's initiatives to develop digital platforms to allow retail investors to access financial markets more easily. So we've seen, for example, new apps that have been introduced in the likes of Mauritius and Kenya. They're available in 8 other countries on the continent as well to bolster retail participation in markets. There's also broad-based improvements to access financial markets more broadly, access to credit and savings, for example. There's open banking guidelines that have been introduced in Nigeria. And interestingly, there's been a directive introduced in Angola, which requires banks to provide services in every municipality in the country. There are various other initiatives. I unfortunately don't have time to run through every single one of them today, but it is encouraging that there's a lot being done on the continent to try and bolster local investor capacity. Financial literacy seems to be a key focus for policymakers on that front. Moving on to pillar 5, which looks at the underlying macroeconomic environment and also some of the transparency around reporting economic data and policy decisions. Here, there's been some divergence. Generally speaking, there's been an increase in country scores for 16 countries. It has fallen in 10 though. And I think this speaks to a couple of interesting points though. Despite the difficult global economic environment, for the majority of African countries, their backdrop is stabilizing. Inflation is coming down. External debt isn't as big of a problem as it was a few years ago. Non-performing loans is coming down in many cases. But there is some divergence. And as I'm sure many of you know, there are some countries that are facing some acute difficulties at this time and have seen their scores drop on this measure. Egypt is one such example. Inflation there has escalated, which has weighed on its score, and it's now moved out of the top 5 on pillar 5. And just to exemplify that trend, this is a slightly funky chart here, but I'll walk you through it. So this is the inflation rate across the MENA block. So the pink line here is showing the median inflation rate. So that's what you can understand as the general inflation rate across the AFME region. If you look towards the right-hand side of the chart, of course, we saw a spike in 2022 alongside what we saw globally with the rise in energy and food prices in particular. But it is starting to come down for most African countries in our sample. And so you can see that pink line is trending lower, which is great news. However, there is a big divergence. And that's the gray area shown in this chart here, which is the interquartile range. So that's the difference between the 75th and the 25th percentile on this measure. So you can see there's a big gap that's opened up on the right-hand side. And that's to say, while in general inflation is coming down across the continent, there are an increasing number of exceptions to that general trend. And so, as mentioned, Egypt is one country where we've seen an escalation in inflation. There are 8 countries right now in the index where inflation is above 20%. So that's one area which has weighed on some countries' scores in pillar 5, sorry. Moving on to pillar 6, this is one that tends to be a bit more slow moving. It's about legal frameworks and the implementation and the use of standard master agreements primarily. Here, scores are unchanged for most countries. Mauritius and South Africa score highest on this measure. They have clean legal opinions from 3 major international trade bodies for their use of standard master agreements. They're the only 2 which has clean opinions from those 3 agencies. One factor that we did introduce into the index this year is signatories to IOSCO. And on that measure, Ghana has improved on its score this year. It became the 17th jurisdiction in the AFME region to become a full signatory to IOSCO. This is an international code of best practice to ensure greater transparency in securities and derivatives markets. So that's seen an improvement there. Although this is a slow-moving pillar, there has been quite a lot of reforms underway, and I'd encourage you to read the reports where we go into some of the details in more example in the likes of Uganda and Tanzania, for example. But we have seen from survey respondents, there are a number of barriers to improving their legal standards. That includes some hurdles in changing domestic regulation, perhaps political hurdles in some cases, or simply a lack of market awareness. Even in cases where there are international standards being applied, there's still some jurisdictions where local guidelines are the ones that there's some inertia in moving away from local guidelines to the international ones. So that wraps up the individual scores. So just to conclude on 3 key points that I would like everyone to take away here. So one, as we've heard already, there are incredibly challenging global conditions right now, but we have seen scores rise in more countries than fall this year. And I think that's testament to the increased resilience that's being built in African financial markets. Some of the steps that we've seen to build the infrastructure include improving product diversity, having progress on incorporating ESG measures into financial markets, and improving transparency in many cases. There is still a long way to go. As we've seen, there's only a handful of countries that score above 60 on our index. And some measures that countries generally score poorly in as around market liquidity, around some of their tax systems and legal systems. And those are areas that can be improved on to promote further investment in Africa. Thank you for listening. I'll encourage you all to read the report in more detail, which goes into all the findings in much more detail than I've just provided now. Thank you for your time. I'd like to invite our panelists for the discussion to go into some of these themes in a lot more detail. Thank you. Is this working? Just to check. Yep, thank you. So yeah, as mentioned, we'll go into some of these themes that I've just described in a bit more detail with our panelists here. So I'd like to introduce Chakulunje, who's the Director of Financial Markets at the Reserve Bank of Malawi. We've got Augustine Simmons, who's Head of Ghana's Fixed Income Markets, part of the Ghana Stock Exchange. Lucy Villa, Vice President of the Senior Credit Officer of the Sovereign Risk Group at Moody's Investor Services. And Emmanuel Maluke Letete, Governor of the Central Bank of Lesotho. Thank you all for joining us. I'd like to start really with, as we've mentioned, of course, there's difficult global conditions right now, and that's weighed on some countries' scores and the size and liquidity of financial markets in many cases. And I'd like to get a better sense as to how that's affected some of the jurisdictions that you oversee on this panel. I think Ghana is maybe a good place to start with on this front, which has seen some difficulties in the past year with default on its debts and some restructurings that have been ongoing in the local debt market. Obviously, could you take us through some of the challenges that you face and how you see the near future developing and how you're trying to improve the conditions in your local markets right now?
Thank you so much. So coming at the back of COVID and the start of the Russia-Ukraine war and the unexpected debt restriction from the government, really the market was totally wiped off. Coming from the previous year when the market was able to do about 230 billion in terms of trading activities on the market. Now, the entire liquidity on the market was wiped off. Nobody wanted to touch the instruments on the market. And so it's really a difficult time for the market. And so how do we continue to maintain liquidity on the market to keep the market there so that we'll see activities on the market? So from the perspective of the stock exchange, we have to do a lot of engagement with participants on the market to engage them, especially the pension fund managers, to engage them so that they will see the need of keeping their expectation on in terms of yields on the from the instrument on the market, because the entire you see the inflation going up, interest rate going up, and in that sense, it affects the pricing of the securities on the market, and therefore, looking at it, if we don't continue to engage them, their expectation will lead to the entire crashing of the market. So we have to do a lot of engagement with the market participants, the pension funds, to ensure that we still have activities on the market. And one important thing we have done is to continue to do investor education on the market. And this, our attention was really on the youth. And so we partnered with a group called the Young Investor Network. And this, our attention was to engage university students from the high school, and continue to let them see the need of investing on the market, so that we will still see activities on the market. So from the previous year, where we having an average of about 1.5 billion in terms of activity, now in daily, you see that the volumes have grown to just about 100 million. So there's a need of a lot of engagement with the market participant to ensure that we keep the liquidity on the market.
Great. Yeah, thank you for that. I think, Chako, I'd like to bring you in here, where I suppose Malawi had seen some similar difficulties last year in particular, with a rise in inflation, falling foreign exchange reserves, which hit some of the domestic financial markets as well. Although it seems like in the past year or so, maybe it's been turning a corner. We've seen the stock market surge, for example. It's one of the few financial markets where equity market capitalization as a share of GDP has increased in the past year. How do you see the scenario in the financial markets in Malawi right now? Do you think it has turned a corner and there's a path to improvement from here?
Yeah, thank you for that question. Yeah, we are turning a corner. For the Malawi market, we are grappling with two things: the lack of depth, because the major instruments are government securities and the stock market, and also the issues that are affecting us, for example, rising inflation, depreciation of the local currency. And also, on the other hand, the good side is that we've seen an increase in pension savings and insurance savings. So there's this part of the savings that's looking for a home, while as we are seeing rising inflation, that is pushing the market out of government debt securities. As you can imagine, a rising interest rate environment means that if you push most of your funding into the government securities, then you might end up on the side of revaluation losses. So most of the pension funds, the new money that's coming into the system because of the increased savings rate on pensions, has found a home in the stock market. And that's why we've seen a huge surge in the stock market. And I think for the first part of 2023, we saw around a 30% revaluation increase in the stock market. So we are turning a corner because there's a lot of positive sentiment because of some of the issues that the policymakers have taken, the progress with discussions with the IMF and some of the regulatory framework. So that has given some confidence into the market to push for funding into the stock market. Nonetheless, this means that on the government securities, because of rising inflation, the appetite is not quite there, especially on the long end of the government curve.
Thank you. I think it's a good time to bring in Lucy. We've heard that there's been difficulties in Ghana and Malawi in fixed income markets. I was wondering if you could give us a broader African perspective across Africa about how you're seeing some of the risks to sovereigns. Do you think a lot of the pain is over, or is there still more to come on that front?
Okay, thank you. I guess if we take a step back and we look at the last 2 to 3 years, I think it's fair to say that the time has been very, very difficult. There was a combination of 3 key factors that really were the kind of combination that affected, I think, the countries on the continent, not all of them. Of course, the picture, as you said, is quite mixed. But I would mention one, of course, the supply side inflation shock, which has been exacerbated in some countries by the fact that the currency was flexible and took a hit and added to the inflation pass-through. Second, the external environment. It is very difficult still today in the current environment, and was difficult already a year ago, to access external funding, especially for sovereigns. And as I'm sure you know, sovereigns in a country tend to have normally the best access to funding externally versus a bank or corporate in that country. And so seeing sovereigns not able to access, or at very prohibitive, costs, of course, make things difficult. So that meant really government had to rely solely on domestic funding. And so really putting pressure on the liquidity of the domestic market. And that is a combination, I think, that we know. We've seen it in 2013, we've seen it in history. What was new is that this just happened when fiscal deficits were massive in many of the countries, not just in Africa, of course, everywhere, but that just added to the pressure also, because then the need for funding was abnormally high just at that precise time. So that's really this combination, I think, that made things very difficult. Out of that, I think we can mention, a few places where, they're not perfect, especially as measured by your index, but the setup of the market, the setup of the FX regime made it maybe a bit more easy for them to go through this difficult time. I would mention South Africa, which is maybe the perfect example you have there, and clearly a very flexible, proven functioning model here. But I would mention Morocco. I think it's fair to say that the market has behaved well and is relatively stable here. I would mention also the WAMU countries. I know they're lower in the ranking of the index, but again here, because of the setup of the WAMU and the fact that there were at least no aggravation of the inflation shock through currency depreciation, because you have a credible peg to the euro, made things maybe easier for them. And the ones, of course, that had the three factors that where you see difficulties went into trouble. So now going ahead, what can happen? I think we are all seeing improvement on the first front. Inflation, your chart was interesting because we're seeing the inflation, at least the medium level, going down. We're seeing it here in Morocco. We're seeing and there are exceptions, as you said, so I'm not going to go back to them. Then you have external funding. Here it's still challenging. And I don't think we can expect official sector, bilateral and multilateral lenders to be able to plug that hole. So, we're waiting and to see whether external funding conditions for sovereigns will improve at a point. And of course, it's not all under their control. What is happening in the US is very important, of course, but also, in the Eurozone. So let's see. And the last thing that countries have under control is the fiscal policy, to remove that fiscal dominance, especially on central banks, and to make sure that also they make, the life of central bankers easier by bringing down fiscal deficit, by lowering their needs. And also, making sure they don't fall into a trap where, still refinancing at relatively high, local currency, domestic costs for a too long time, you see. So the ones that can bring that fiscal deficit relatively quickly down are at least the one who can manage and keep things under control, I would say. And we're seeing some, improvement on that front. So we're remaining relatively optimistic on that front, but those conversely who would have difficulty to do that, then this bridge that local currency domestic funding provides and should be just, short-term bridge. You will see the same kind of liquidity troubles we've seen in countries on the continent. Thanks.
Yeah, thank you. I think that's a useful framework for thinking through it, that despite the difficult external financing conditions, that is still somewhat under the policymakers' control to be able to support the local markets and have that financing. I think this is maybe one question that I wanted to bring to you, Emmanuel, about how at an earlier stage of development for your financial markets, but it does look like Lesotho is making progress in building its local fixed income market. Could you speak to some of the trends that have been occurring in your jurisdiction over the past year or so, and what are the next steps forward for you in building that market?
Thank you very much. Let me just start by thanking you for really inviting us to this panel. Yes, it has been a very difficult time for us during the past previous years. But importantly, let me say, as a latecomer in the market, if you recall well, we only had the stock market in 2017, and we are basically playing a catch-up game here and quite very difficult. But where we are standing, I think we have actually done quite well to our standards. And at least I see that we have been able to move a number of steps upwards, in particular, when you look at the pension side, it still appears to have done relatively well. When you look at the bond and treasury market side, we've really very world-class infrastructure. We have done very well. Yes, there are issues that we are confronted with, which I think are making us not perform so well. In particular, the issues of tax regime, the issues of enforceability. It is very important to note that we are drafting new legislation. We are also trying to look into double taxation treaties, improve on some of these weaknesses. But it has been very complex and difficult for us, in particular, where you do exist within a broader, bigger economy, the South African economy, with far advanced capital market, where companies themselves that come into the country are already listed from South African side. And you also want now to promote your equity market on the side for the companies already listed on a bigger stock exchange. That has been really, really a bigger challenge. But in as far as we are concerned, we are currently developing the second financial sector strategy, in which case we are really looking forward to creation of a better financial market, to really looking at the issues of ESG with the appropriate legislation. And we hope that in the next 5-6 years or so, we should be able to rank even better in terms of capital market, in terms of equity market in particular. And this is where we are really lagging behind most of the times. But at the same time, we are also trying to build an entrepreneurship ecosystem where we are trying to really encourage companies to come on board and list. And let's recall also finally that we are coming from more of a state-owned economy where a lot of companies have remained with government as well. We are encouraging the government to allow these companies to list in the stock market, in the stock market, in the stock exchange, so that they can serve, of course, as an example to really the private sector to be able to come on board. In terms of transparency, we are working together holistically with Revenue Authority and other people to ensure that at least we have transparent tax system that investors can be able to see wherever they are, abroad or inside the economy.
Thank you. Yeah, it seems like there's quite a few initiatives going on there. One that one that you mentioned, which I'd like to ask the panel here, is what you mentioned on ESG, which, as we've seen, is there's been broad-based progress on that front in the last few years on the index. Augustine, I'd like to come to you on this, where the Ghana Stock Exchange, for example, issued new guidelines and disclosure frameworks for ESG. Could you talk a bit on that and what measures you've introduced on that front?
Thank you. So the exchange on its own has developed and then launched the green bond market for a start. So there are create the framework for potential issuers to be able to come to the market and issue green and sustainable themed products on the market. Again, the National Pensions Regulatory Authority has also given guidelines to all the institutions that is regulated to ensure that in their investment, the investment guideline guide them to invest portions of their holdings in such products as they come onto the market. We also have issued the ESG guidelines for listed companies that are listed on the exchange to report on their ESG activities as they report their financial reports onto the market. So they should clearly indicate what are the activities, how their operations are impacting on the environment, what social activities that they are doing that's impacting on the society, what gender activities that they are involving in to improve gender inclusion in their activities, and then also corporate governance issues that they are involved in. So these should be clearly reported on as they give their financials onto the market. There's a lot of, after the launch, there are a lot of workshops to ensure that the market or the issuers on the market clearly understand what they have to do when it comes to reporting. Then we have the central bank has also given out banking green sustainable financing principles to guide the banks as to how their operations or their funding organizations and institutions with respect to the mining, agriculture, and company operations that affect the environment. So they clearly should report on all of these. And so these are some of the things that as a market we are doing to ensure that our ESG is really impacted.
And just a quick follow-up to that. I mean, this is something I think Jeff mentioned, is that in this environment where there's difficult external, and I guess in the case of Ghana, domestic conditions, do you see sustainability as a real opportunity to unlock a new source of financing?
Yes. So that's very key as we these guidelines are being provided, where now we don't have any product that has come onto the market yet, but it's hopeful that with a few years to come, or we're hoping that we'll have organizations coming onto the market. The environment is not, because of the economic environment, interest rate very high. We're not seeing any companies coming on to issue instruments yet in that direction, but we're hoping that we should have some activities coming up in that area as the environment, conducive environments come up. Okay.
Thank you. And similar question to you, Chaku, is do you see an opportunity in Malawi for improving access to financing through sustainable means?
Yeah, for Malawi, we see the opportunity that lies in sustainable investments. We're still in our infancy in trying to develop that part of the market. So as a central bank, what we did was to approach the NDC partnership on greening the financial system. What we want to do is to have a complete capital markets diagnostic analysis done, to see which aspects of greening the financial system we can work with, considering the type of market that we have. So we are looking at issues of climate change and how that has impacted our country. I think you may be aware that we had quite devastating cyclones. So there is need as a country for us to ensure that we are protected from some of these climate change issues that are affecting our economy. And I think the cyclone contributed to a lot of negativity in our macroeconomic environment. So we're still in our infancy stage. As I said, we've just approached NDC partnership. We're looking at the assessment and the assistance that they're going to provide. They're going to do a review process and look at the proposals that we've made to see how we can get assistance in bringing in financing through the sustainable development goals aspect.
Thank you. And I think, Emmanuel, if you could maybe speak to, you mentioned ESG sort of in passing in your previous comments. Could you give a bit more details about what your thinking is on that front?
Yes, thank you very much. I will start first by reminding that in the small economy, we have a lot of water, and of course, we have solar and wind power. A pipeline of projects are there now on the part of government, and these projects really require us to deeper into ESG, and they require us to look into how we can best come up with at least some guidelines, in particular insofar as raising funds is concerned. So as a way forward, what we are doing now, we are trying to really establish how we can come up with these guidelines to enable the issuance of green bonds. And this is exactly where we are. And we are thinking that probably in the next 1 to 2 years, we should be able to have issued these guidelines and enable these projects to really take off from the ground. And this is exactly what we have given now as a priority, with assistance now from the fund and other people that will be helping us to drop these guidelines. And I think we are going to make progress in that sphere. But a number of projects have already been financed, really taking into account the ESG matters, in particular those projects that had been financed by the World Bank. But we are really now on the financial sector trying to clean the financial sector. We are trying to ensure that we have these guidelines, and that I think we take it as a priority where we are standing. We have just had a conference in June where we're looking in these matters in totality. And I think there is an action plan now that we are really going to work very hard in terms of really come up with a clear framework on the financial sector regarding.
Thank you. So Lucy, you've heard from the panelists here that ESG does seem to be a big priority area that's been worked on in Malawi, Ghana, and Lesotho. How do you see this space developing, and both, I suppose, in terms of how sovereigns are dealing with climate change? We've already heard, for example, the cyclone that affected Malawi has had negative macro consequences. Do you see that being a key risk for sovereigns, or also where are the opportunities within ESG?
I mean, this is definitively a risk that, to be honest, we've always incorporated in our analysis. We never labeled it with the ESG world, but it's interesting. And we did the exercise. We went back at several, decades, I would say, of research and rating actions and looking at, mention of this event, and you find some. So that was definitively already there. At Moody's, as a rating agency, we used to, codify risks. And so, of course, that was a kind of normal, natural step for us to have, ESG risk measure, which we do for all sovereigns. So we did that. Now, if I may, what I find interesting here is that we're hearing a lot of initiatives from all the countries on the continent, which I find very encouraging, because clearly understanding that there will be more and more funding opportunity related to projects and funding of that projects that in these areas. And so it's good to see that, everybody is following. I guess where we're a bit more nuanced in this, encouragement and positive steps is when we look at the amount of funding flowing in this domain. We're still very short a fraction of the funding gap measures that that we know that we find in from the usual international institutions. And so I think what we're looking for now is that we see that all the countries are clearly on board and adjusting their framework, is whether we'll see more money flowing in that domain. That's for us, the key question.
Do you think in that sense, and I think Augustine sort of touched on it, that you need the conducive framework first, or the right market conditions and the right macro conditions, I suppose. Does that then speak to your previous point about the different steps and maybe reining in fiscal deficits is a precondition to unlocking that financing?
Yeah, and in any cases, I think the credit risk attached to a country will still be something that will guide investment, even though there will be other considerations in this investment decision. And so yes, a necessary condition, I think, is macro stability, as was alluded to before, and etc. And yeah, so that we would need to see it. But even in countries where I would say macro stability is to a certain degree there, we made a calculation, and I think if we aggregate everything and we look at the needs that are calculated, we still a fraction of it. And the question is how you bridge that gap and how you make sure you have enough funding coming in.
Thank you. I still have a few questions of my own, but I'd like to open up to the audience here in the room, but also virtually. If you have any questions, please send them through. I'd like to invite Anthony Kuroy, the Managing Director of Global Markets at Absa, for our first question. Just to let you know, Anthony worked very closely on this report alongside Jeff from Absa with us at OMFIF. So yeah, could you provide us with a question based on some of the research that you've helped put together here?
Thanks, Nikhil, and thank you to the esteemed panel indeed for your insights and your comments and your observations. My question is, now that we're here 7 years from when we started this report, looking back on the journey we're on, the first time we're actually having the launch in Africa, which is also exciting for us. But as we look to the future, and especially from your perspective, 7 years from now, 2030, as we launch the 14th report, the annual report, the Absa Financial Markets Index, what would you like to see as having been accomplished during that time? And looking forward into the future, what would you be excited to be here on the continent, hopefully, for the 14th launch and be celebrating? So over to the panel. Thank you, Nikhil.
Thank you, Anthony. So yeah, maybe we can go down the panel. So Chaku, where would you like to see Malawi in 2030?
Obviously, the ambition is to have deeper, easily accessible financial markets where liquidity is not really an issue. Our ambition is to chase South Africa and to be able to provide products that can allow market participants to comfortably invest in our markets. So currently, what we're doing is we have what we call a capital market development plan. It looks at where we are today and how we can push ourselves forward. So we're looking at projecting how much liquidity will be in the market. We're looking at financial literacy. Obviously, we need the investing public to be knowledgeable about the investments that they're making. We're looking at sustainability, which aspects of the market we can get into, and how can we ensure that the investments that we're making are good for our environment, are sustainable, and will provide the type of financing that will cover the country against some of the climate shocks that we've been facing. We're looking at depth and liquidity. How do we ensure that market participants are able to easily get into and out of our markets without any problems, where we have players that will, provide both sides of the market without any issues. And we're looking at a conducive regulatory environment. Obviously, if regulation is a hindrance in a financial market, then the ambitions that we have would not be realized. So the plan that we have touches on all of those aspects. We touch on financial literacy, we touch on sustainability, we touch on depth and access, and all of those markets. So the vision is to have a more vibrant and more deep financial market.
Thank you. Same question to you, Augustine. Where would you like to see Ghana in their financial markets in 2030?
Well, indeed, when the index was launched, we have really used the pillars to help develop our market. So the years ahead, we want to see an efficient securities market that impacts on the national development of the economy. We should be more relevant to the economy, where we see government and corporate institutions coming to the market to raise funding, to provide social amenities and infrastructure in the country. We want to see how the market is impacting on the companies that are able to easily come onto the market, raise funding to expand operations, to create employment, to be able to solve the unemployment that is really growing in the economy, so that we have our teaming youth that are coming from the university be able to find employment and create work for themselves. And we also want to see a market that is really diverse in terms of products. So now currently there are a process going on where market rules are being developed to enable all sort of products to be able to listed on the market and traded on, for instance, asset-backed securities, business lending and borrowing, and all sort of products to enable the market really grow. We're looking at deepening the depth of the market so that people can really come onto the markets and trade. And what is also key is for us to be able to have a more knowledgeable investor community. So investor education has become very key on the market. So we ensure that not only do we put out developed products and bring them onto the market, but with the investor community, do they understand what product we are bringing onto the market? Do they appreciate it? Can they really put their investment in there? So there's a lot of education that are going on to ensure that we have more knowledgeable investor community on the market.
Thank you. Emmanuel, same question. It seems like there's some common themes here around financial and investor education and improving the depths and products available. Is that similar on your side?
For me, I think really in the next number of years from here, I would want to see the markets that can channel funds for real estate. And I have argued many times that Africa totality does not need foreign aid. It needs to develop its capital markets. It needs to develop its financial market. There are resources, but such resources at the same time, they need investor protection. Very clear. They need transparency in regulatory framework. Once this is done, I believe that next number of years to come, to see better African financial markets that can solve a lot of challenges that African countries are facing today, in particular, there's challenges of reigniting growth across the continent. And that definitely, if we work hard, we should be able to achieve in the next 10, 20 years. And Africa should be different from what it is today.
Thank you. And Lucy, are you optimistic that things are moving in the right direction based on some of the initiatives we've heard here? And
Absolutely. What you've done here in terms of this index, it gives us a push. It gives us to really try to see how we can harmonize. It says to us, look, you are lagging behind the area A, you are lagging behind area B. What is it that will take from here? How do we move faster so that you are never left by peers as well? And that itself really stimulates further and further discussions beyond this boardroom, even your own boardrooms at home. So to me, I think we are really on the right direction. And I thank Absa for doing this. This is going to be really a big push for a number of African countries to try to develop financial markets that are really meaningful and important for the people of Africa.
Thank you. Yeah, it's great to hear that the research that we work on closely with Absa is having a positive impact to shine a light on these initiatives and how policymakers can learn from each other, really. But yeah, Lucy, are you optimistic really on this front, or are we going to end with a negative note here?
No, not at all, especially since I'm the last one to speak. No, I think the only thing we want to say is, I would like to say is that we recognize that kind of long, hanging fruit kind of, initiatives. This is not tomorrow that, that pension, funds or assets under management would, be triple the size of what we have today, or will be what we see in Namibia or South Africa, everywhere. But yeah, going at least in the right direction and recognizing that it's relatively long routes to reach that level. Must say also that, and we like very much first, the report. We use it a lot. I discuss with colleagues, the way they use the ranking. We have the same kind of analysis internally, of course, and that feed into our assessment. We look more at cross countries comparison, not just Africa. And one of the feedback we were making was that, okay, it's tough also because South Africa tends to be, in our view, even benchmarking against other emerging market, large one, outside the continent tends to be actually pretty deep, probably the deepest of all emerging market. And so I think, measuring relatively speaking to South Africa, put the bar very high to the others, but I think it's good to have high vision.
Yeah, well, then I guess on your front from Malawi, you're chasing after South Africa, not just as the deepest market in Africa, but perhaps in emerging markets more broadly, which, yeah, it's a good benchmark to have, I guess. We have one question from the audience, and then unfortunately, I think we'll have to wrap up. But, yeah.
Thank you very much. The question is to Lucy and perhaps, hello, first of all. I'm Mahesh Kotecha. I'm a financial advisor, including on ratings. To what extent does rating assessment of countries take into account the kind of parameters that the index is measuring? And to what extent does the information that the index is able to gather and collate and put together in a comprehensive fashion, which is very impressive, feed into positively or otherwise your rating assessments of individual countries? Maybe some illustrations.
Thank you, Mahesh, and hi to you too. It does a lot. As I said, we tend to have a more international angle to it because we compare not just African sovereigns among themselves, but of course, outside. I think the slight difference would be that we may be less, relative, and we have kind of typical benchmark of what is a relatively large, pension fund ecosystem in a given country, and we measure typically as a percentage of GDP. So we have slight differences in our approach, and we focus more on basically how deep is the local market for the government to be able to access funding, but also for the rest of the economic actors like, corporates to access funding and use it in a relatively productive way. So that's the key thing. The other maybe angle that for us is very is quite important is the access to non-residents, so external investors in local currency funding, because often the difficulty is that if it's in dollar, then the borrower take on the FX risk, which can be a difficulty. And that's where South Africa, I think, fits in our mind as a key example, because here you clearly have it. It's not just, of course, debt instrument, it's equity instrument, and it's not just about the sovereign, but there is clearly a large pool of bankable borrowers out there, and that you have investors willing to take, the exchange rate risk. And the good thing with that is that when you establish yourself and you reach that level, then it tends to be sticky, because it's a bit self-fulfilling when you reach that status, because it's viewed as a relatively liquid asset. It entertains itself, and it can even, sometimes allow some loosening in fiscal policy and so on and so forth, and you still don't see the type of prices you would see in other countries. So that's the kind of benchmark I would say we have in mind. So if you focus on our methodology, it would be very clear in terms of accessing local currency funding, foreign currency funding, and from what type of invest.
Yeah, and that's one area we consider, perhaps not in much detail, but we look at in Pillar 1, for example, the availability of assets in different international currencies like dollars and euros, for example, as well as a different type of hedging products that are available, because it's important, as you mentioned, that it can help to access international financing. Unfortunately, we'll have to wrap up. I mean, I'm sure there's many more areas that we could discuss, which is perhaps for another day. I'd like to thank the panelists here, to Chaku, Augustine, Lucy, and Emmanuel, and for everyone here attending, both in the room and virtually. As part of this project, we continue the conversations. There'll be some country launches that we'll be doing to go into some of the findings in more detail, and various events that both Absa and ourselves at OMFIF will be doing to further explore this topic of financial market development across Africa. And of course, we'll be continuing to work to keep producing these indices, and hope to see you all in 2030 for our 14th edition. Thank you, and I'll hand over to Ellie now.
Ori Rottenbach, who is the Chief Executive Officer at Absa Group. Thank you so much. And also, I just want to say thank you again to Jeff, to Anthony, to Nikhil, the OMFIF team, and also Absa and the United Nations Economic Commission for Africa. It's a real team effort bringing this all together. So thank you so much, Ori.
Yeah, good morning, ladies and gentlemen, esteemed guests. Very exciting, energetic conversation. It's my pleasure to close this morning's proceedings, which of course I will keep very brief, as there's been much discussion already on the richness of the findings of the AFME report this morning. I'm excited to see that even after 7 years, the index continues to expand, now at 28 countries. As you have heard this morning, it is through the support of partners like the United Nations Economic Commission for Africa that we are able to continue to expand the coverage of the AFME report. It's important for the continent to have measures like the Financial Markets Index guiding us on progress around financial product diversity, ESG, market frameworks, as we heard this morning, big topic, adopting digital technologies, and strengthening legal frameworks. Continued progress on all of these fronts will be crucial to improve Africa's appeal and access to investors, enabling the continent to develop its resilience against the backdrop of a challenging global macroeconomic climate. We've heard a lot about the macroeconomic environment across the continent this morning. While we are seeing positive signs of general improvement, there remains a concern with many survey participants citing inflation as a significant challenge to their capital markets. The recent successive negative shocks such as COVID-19 and the Russia-Ukraine conflict, contributed to the deterioration of the macroeconomic fundamentals across the continent, particularly to the sovereign debt balances in many markets. The report indicates that fiscal space, sound macroeconomic principles, and the strategic investment opportunities remain key to responding to the current economic realities faced across the Pan-African markets. Despite this, the participants mentioned various financial inclusion initiatives aimed at boosting local investor capacity. This shows us there is scope for further progress, growth, and development, while recognizing the need to continue to focus on overcoming the headwinds. On that note, I would like to close by thanking John Orchard for the continued support and partnership in the production of the AFME, and to our esteemed panelists for a very important analysis this morning and a very exciting conversation on the economic trends in Africa. Thank you again for joining us today in the room and also virtually around the world. I trust that you will benefit from the many insights shared this morning and that you will read in the detailed index. Thank you once again.